On today's Hashi, I'm discussing the CPI report for May, a new record high for investor selling and mortgage applications for the past week. Today is Wednesday, June 11, 2025. I am Byron Lazine, and the hot sheet starts now. Good morning, live from Naples. Let me know in the live chat which market you are tuning in from, wherever you may be today. It's CPI day, and we're looking at this very closely as the Fed, the FOMC, gets ready to meet next week and make their decision. Now, I've never seen a CME prediction 7 days out like the one I saw this morning on what the Fed is going to do. So CPI comes out, and expectations were beat. So that's good news. Okay. U.S. inflation, according to CPI, goes up 0.1% in May from the prior month. That's less than expected. Okay. Expectations were looking for a reading of 0.2%. So once again, another month now. And May data is important, right? Because when was the big tariff day? It was beginning of April. Okay. So April's data, you looked at it and you said, hey, we were pretty good on inflation, but this Trump tariff stuff really hasn't kicked in yet. Wait till we get that May report. The tariff doom and gloom. Say, hey, tariffs are going to blow this thing up. Inflation's going to go through the roof. Well, you have now, that's the second month into tariffs, and the market's expecting hotter inflation, and CPI comes out and it's 0.1%. It's kind of a nothing burger. Okay. It's better than expectations. So May comes in at 0.1% on CPI. I mean, you've had 3-4 months now on month-to-month percent change on CPI. They've been very good. Okay. If the goal is to get inflation down, yeah, the last 3 months have really shown that's the case. Okay. I mean, this is a continuation of a trend of inflation moving down, not up. Again, the expectations were that this could go the other direction. Not the case. Not the case. So we're seeing inflation in a pretty good spot. And that's going to have an impact on what the Fed's going to do next week, right? So Fed's moving, or the Fed's going to be meeting next week. You figure when inflation moves down, they might be more like, hey, it's getting to where we need it to be. Maybe we'll start cutting. We're going to give you with CME Group. I'll give you what CME Group's here thinks in just a second. Never seen a CME prediction like this 7 days out from the meeting. Let's dig a little bit deeper first. Bureau of Labor Statistics put the report out 8:30 a.m. Eastern time this morning. And we see that the index for shelter is the primary factor. So index for shelter rose 0.3%. It's the primary factor in the all items monthly increase. So you pull shelter out of it, could have been in the negatives. Certainly, wouldn't have had any increase. And, this is, again, when you look at CPI, Jerome Powell has said this is lagging data. It's, takes 2 years to catch up. I mean, I'm at the point right now where I'm like, when is it going to catch up in regards to shelter? We just took a look at this on Monday with the rental report. I mean, we're into 2 years now of rents going down, not up. Okay. So inflation doesn't mean that prices go back to, to get inflation down on 2% target. The dual mandate for the Fed is 2% on inflation. And by the way, all items for the 12 months is at 2.4% before seasonal adjustment. That's where it's at. So it's 2% for the Fed's target and maximize employment. Well, in getting inflation down to their target does not mean prices go back to 2019 levels. Okay. Everybody looking to, purchase furniture and different items in their life that were available in 2019. No, that's past. Okay. Some of the increases in the grocery store aren't going back to 2019, aren't going back to 2020. They're just kind of stuck in time. The point of getting inflation down is the rate at which they continuously increase slows down. Okay. And that's what has happened in rental real estate over the last couple of years. It's been flatter down. for the last 2 years. So I don't get a lot of the CPI data around it. A lot of it's mixed into that 1980s survey that is done on owner's equivalent rent. In the Wall Street Journal agrees with me. It is a made up, make believe survey. Not that you want to line up on everything with the Wall Street Journal. I'm just pointing out, Wall Street Journal's done a study on this. This is not relevant information. It's not looking at, we have so much now today data to look at, and we're looking at surveys from consumers, owner's equivalent rent. It's silly. It's outdated. It doesn't work. Owner's equivalent rent here makes up 26%. So it's over 25% of the report. And owner's equivalent rent comes in at 0.3 for May after previous months of 0.4, 0.4. So down a little bit. Again, shelter coming in at 0.3, matching last month. Shelter now down at a 3.9 here for the year over year, where owners of equivalent rent of residence is at 4.2. So 3.9 on shelter, 4.2 on owners equivalent rent of residences. That's what's pulling this CPI number up. 2.4. We'd be below 2 if you pull this data out. And I've made the argument now for many, many months that you should be pulling owner's equivalent rent out. It's not real-time data. I don't want to go off a consumer survey, when it comes to how we're making decisions about the economy. If you call somebody in your town and ask them what their house would rent at, are they going to be, is that going to be the answer you run with? Or is it going to be your due diligence, your professional analysis, talking to people who actually do it every single day, like landlords and investors and that type of scenario? So there you go. Some other things that stuck out here in the report. Indexes that increased would be medical care, motor vehicle insurance, household furnishings, operations, personal care, education. Okay. Airline fares, used cars, trucks, new vehicles, apparel were among the major indexes that decreased. Okay. So new cars, you can see it. There's deals on cars that are happening all across the board. Well, the numbers are moving down. Okay. Furniture, personal care, education, motor vehicle insurance going up. Those are the items outside of shelter that really had the biggest move up. Here's the month over month change. So March down 0.1%, April up 0.2. People were concerned in April about May being a big a month where it could get out of control because you had more time for the tariffs to kind of work themselves in. Wasn't the case. Expectations were that we'd match April at 0.2. It comes in at 0.1. So CPI here, inflation beats expectations, comes in at 2.4% on the annual. And that met expectations of 2.4. So the month is what beat expectations. The annual beats expectations. And the tariffs have yet to make an impact in hard data. Okay. There's still soft data out there, or concerns or fears that it might do something. But the data that we have, hard data, just like when we look at jobs, suggests otherwise. Okay. If you're looking for recession, well, job data suggests otherwise. This inflation data and how it relates to tariff, it just suggests otherwise. Okay. And even with this news here this morning, okay. It was, wow, this is interesting. I should have taken a screenshot. Just about 10 minutes ago, it was 100% that the Fed would stay 4.25 to 4.50. Okay. Now it's 99.8%. And for the first time that I can remember, definitely all year, the CME group is now saying there's actually some level of a chance, 0.2% of a chance, that the Fed will increase the rate when they meet next week to 4.5 to 4.75 range. Wow. So there was one bar here 10 minutes ago and it said 100%. I never have seen 100%. I thought it would stay. Literally in 15 minutes, it changed. But it said 100% chance that it would stay at the 4.25 to 4.50 range, which is where we're at. Okay, so no change in the rate, 99.8%. There's now actually a 0.2% chance that it'll go up, not down. Okay, the 4.50 to 4.75, it means that they're going to increase, which would go completely against where the current administration wants. Remember, the pressure from the current administration right now is lower the rates, Fed, lower the rates. They want to get long-term, they want to get the 10-year down. Remember, they're trying to pass a big bill, and the bill doesn't cooperate with the long-term rates. So they want the Fed to lower the rates to try to push the long-term rates down. There's a lot of debt that, we need somebody to buy our debt. And so they want it more attractive. They want these rates to go down. And they want the 30-year fix to go down. Okay. The administration has been very clear on that. They want to get 6%. I was talking to Logan Mohtashami this week when we were together at the gathering, and he believes 6% for a prolonged period of time equals 5.5 million on existing home sales. What does that do to the economy and consumer confidence? Quite the boom. 1% down on the 30-year fix. He believes we get 1.5 million more transactions from where we're trending at right now. That's 3 million sides. It's a whole lot of appraisal work, lender work, inspector work, handyman work, moving services. That's quite the boom. You get the 30-year fix to come down 1%. You have a huge localized boom in every market across the country in what happens with transactions. Based on what CME Group thinks about the Fed's meeting here in 7 days, we're going to break it all down next week, as we always do during Fed week. They think there's no chance that the administration gets help from the Fed, so they're going to have to go in another direction. Administration is going to have to use what tools they have available to try to move this number down. Not going to happen seemingly here this week. We do see that the 10-year is down a little bit here with the news, 4.44 with the CPI news. So still trending around some of the high levels we've seen over the last 90 days. So we're going to hover around 7%, just under it on the 30-year fix, despite where we're hovering. I've got some mortgage application data that we'll get to here in just a second that was pretty shocking. Market hasn't done much of a move here on the open here today. Stock market, it's got this CPI data. It's kind of just flat out of the gates. The NASDAQ, S&P, Dow, all just basically coming into the morning here flat, waiting to see what's going to happen with this China-U.S. trade framework that was announced over the night. And that's really where the stock market's at. So no impact on the stock market with CPI. Not really much there on the 10-year. Certainly CME Group believes the Fed has no willingness to cut right now. And so there's your latest update across the economy. Realtor.com puts out a report here in the last couple of days on investors. Okay. I'd make the argument right now, if you're working with buyers, I'd make the argument that, listen, a couple of years ago when investors stopped buying properties, a year and a half ago, think about it, right? When rates were kind of where they are now, but rates were high. There was the shock of rates, and there was still very low inventory. Think about inventory. BMX members, you guys obviously can pull this chart here at the, every single week. I give you all of the, go to Classroom and go to Hot Sheet. I'm sorry. I'll have to just quickly log in and I'll get you there. But you just go into the Classroom for Hot Sheet and give you the data every single week here. I'll do that right now. We'll go to Hot Sheet. And remember, if we look at just, if we look at Monday, for example, and we look at inventory as we do on Mondays each and every single week, this is Altos Research. A couple of years ago, like 2023 and 22, This time frame right here, inventory was so much lower than it is today. Even just last year, 32% more. So in that low inventory, competitive in more markets, not just the Northeast, but competitive across the board for investors, they pulled back. Well, what have investors done here today? What are they doing right now? Okay. Investor buyer share is moving higher. Investors are re-entering the market. Now, investors are also selling off because prices are still high. But when I look at that buy side, it's interesting to me because when I'm working with buyers and buyers want to time the market. Okay. I think they learned this from the Bitcoin boys and the retail Robin Hood traders. They want to try to time the market. We know it's not possible. And if you're buying on a 9 to 12 year homeowner 10-year run, which is the average, it's also just not smart to try to time. You're going to miss out on opportunities. But as I see buyer investors re-entering the market right now, that tells me they're seeing opportunity. They're seeing hesitancy. When they see hesitancy and uncertainty, that's when they want to be buyers. And that's when you want to be a buyer too. As a retail buyer for single family homes, if investors are out there seeing value, that's when you should be shopping as well. So I see opportunities now. Investors are buying for the future. That means the future is going to be brighter. This mortgage application data certainly shows us that is going to be the case. Investor buying outpaced selling by the smallest margin since 2019. So, there are still investors that are selling. It hits a new high. 10.8% of sellers were investors in 24. It's the highest investor seller share in data's history. That's up from 10.1 in 23, roughly 8% from 18 to 21. So these aren't big moves up, but it is record high. People are cashing out. They got great deals in 2019 and 2020. It's why if you were listening to all these idiots on the internet that said, hey, don't buy in 20, don't buy in 21, don't buy in 22, they look really dumb now, okay? 13% of homes purchased in 2024 were by an investor. Wow. In 2024, with inventory lower, competition higher, deals harder to find than it is in 2025, 13% were bought by investors. The future looks bright, buyers. Don't wait. Okay. If you're a retail buyer, it's time to move. If you wait until rates come down to 6%, all the other retail buyers, all your normal buyers are coming out of the market. Slightly more homes were bought by investors in 24, while fewer homes were bought, resulting in higher investor buyer share than in 23. Okay. Here are the states with the most investor activity coming out of 24. Missouri, Oklahoma, Kansas. They saw the highest buyer share of home purchases. And then Oklahoma also on the list, Missouri also on the list, and Georgia enters for highest share of investor sellers. Okay. So states where investors are actually affecting supply and demand, scaled by total home sales. Hawaii, Montana, and DC saw the largest net negative impact of investors on housing supply, more buyers than sellers, while California, Minnesota, and Oregon saw the largest net positive impact of investors on supply, more sellers than buyers. All right. Here's your investor activity peak falls from peak. Still a high share of buyers. Okay. That's more interesting to me than how many investors are selling. Okay. It's the fact that, you're falling from 14.4% peak when rates were nothing for investor buyers down to what? 13.5, not even a full point. Investors are still, we're not at, 2017, 18, 19 levels. Investors, we heard this from the JP Morgan analyst. Like, if I can buy single family home under cost to duplicate, if it costs to replace, if I can find any home on the market under the cost of what it would cost me to replace that particular home brand new, I'm buying it. That's what JP Morgan's, they're like, we're pushing money into this, into this part of the market, single family homes, where it's under cost to replace. Investors, with rates being high, with uncertainty, tariff talk, all of it, 13.5% of purchases are investors, 13% for the full year in 24. Very, very high level of interest for investors. And it's not Wall Street, guys. Don't get caught up into some of these accounts on IG telling you that Wall Street's ruining the housing market. That's clickbait. I know it's, if I put out a video like that on IG, I see some people doing it on IG, talking about these conspiracies of, the Wall Street companies buying up all the real estate and all of this kind of stuff. I could get hundreds of thousands of views on that because it speaks straight to the heart of the doom and gloom mentality on the internet. The reality is, when it comes to investment purchases, which is not the totality of purchases, obviously, it's a smaller segment, but 59.2% of just investor purchases in 2024 were small investors. Okay. It's the highest small investor share in the data's history since 2001. Okay. Large investors, Wall Street investors, fell to 21.7% of the investor purchase pie. Don't get these numbers confused. Not 21% of purchases. Of the investor purchase pie, 21.7% were large investors, which was the lowest share since 2007. Wall Street's not the reason buyers can't find a home. Our lack of affordability, our lack of building affordable homes is the reason not every buyer can find a home, or they just don't qualify. That's the other part of the reality. Everybody with a dream, every dream doesn't come true. I wish it did. Okay. The home ownership rates have never been 100% for a reason. Not everybody even wants to own a home. Okay. I wish the number was higher. I think it's, long-term, it's been proven out, long-term wealth. It's one of those core staples of it. Small investors purchased 362,000 homes in 2024. It's up 3.7% year over year. Large investors purchased 132,000 homes. It's down 8.7%, lowest level since 2018. So 132,000 homes on the, 4 million, and existing home sales were 4 million. You put new in there, close to 5 million on total sales, and investors bought 132,000 of them. Okay. So Wall Street doesn't own all the homes. And obviously we'll put this data in there for you inside of BAMX. So just jump onto School if you're a member and grab it. Investor cash share was also the lowest since 2007. Overall cash purchase near decade plus high. Okay. So overall cash share, 33.4%. And then investor cash share, 62.3%. So 62 point investors say, hey, if I'm going to buy, I'm going to go cash. The overall cash share on the decline there. And so there you go on that. The investor seller activity, again, peaking here to 10.8%. Just a number of years ago, it was at 8%. The investor purchases, though, are still outpacing sales. So yeah, there's investors cashing out, but the reality is they still see a very bright future in owning real estate, or they wouldn't be doing it. There's still buyers in the market. They're trading some out, but buying back in. Now, if all the investors were selling and no investors were buying, that might be a signal that, hey, some of this uncertainty is more than soft data. It's something to really be concerned about. But not the case. we have a housing supply shortage that spans over a decade, and investors are continuing to cash kind of in on that. Here's some other stats here for different states. We talked about Missouri, Oklahoma, Kansas, Utah. Also a high share of investor buyers: Georgia, Montana, Mississippi, Wyoming, Indiana, and Alabama on that list. And if you look at year over year numbers, we have those here for you as well. Year over year increases in, say, Kansas up 1.8, Mississippi up 3.6, Nevada up 2.8. Okay. There you go. There's your investor update. Punchline for me. A lot of data in here. We've got it inside of school for you. You want to pull some of these charts, uploaded those into school for BAMX members as well as the full report. Everything that you need in there. Punchline for me is, hey, investors are buying more than they're selling right now in a 7% environment. They're getting ready for a 6% environment because investors understand what's going to happen in a 6% environment. All the retail, the homeowner comes into the market at 6%. It's what Logan said to me in Colorado Springs this week. 5.5 million on existing sales. And when that happens, you want to have already owned the real estate. And you want to be shopping with everybody else. Who wants to shop on Black Friday when you can get a deal the week before when nobody's in the store? Crazy people want to go to Black Friday. I know it's nostalgic and it's fun, but if you actually need something, like if I got to just get to the store because I need this item right now, I don't want to fight through Black Friday. Okay. And listen, it'll be the opposite in real estate. There won't be deals. There won't be creative marketing. There won't be buyer incentives at 6. The market will be quite the opposite. Prices will be going the other direction. What direction is mortgage applications going? This one, to me, is great news for the future. Okay. I mean, you get to 6%. Logan is going to have nailed it. Mortgage applications increased despite no drop in the 30-year fix to 12.5% from a week earlier. Mortgage Banker Association. The week prior was the Memorial Day. They had the adjustment in there. But this is just incredible. The number we care about, purchase index, increased 10% from 1 week earlier, 20% for the same percent higher than the same week a year ago. I think that's now 19 weeks of year over year growth for the same week year over year. Just absolutely huge numbers. And it's not like the rates went from 7 to 6.5. They're still hovering around 7. Overall, this mortgage application data is still hovering around 30-year lows. But it's improving and it's trending up, and we're doing way better than we were last year when it comes to mortgage application data. And I think it's 19 weeks now, okay, where we've seen a year over year improvement. Purchase activity up 20% year over year, unadjusted, according to Mortgage Banker Association. Hey, the future viability of buyers, it's there. We got to get the 30-year now to kind of help out. We need that tailwind. That 6% tailwind would be huge. We ended the day yesterday at 6.93. We'll see where we come in today. Likely not much of a change, but still just kind of hovering below 7%. BAMX members in school today, 3 p.m. Eastern. I'm doing the office hours. I've got Sheila from Mosaic. That webinar we did on the buyer guide stuff was so well received. We'll be talking about more ways to kind of implement that into your business. And, what are the things that I would be doing in the pitch? Okay. So, I mean, a lot of what we talk about here on the hot sheet is going to be, the data. Hey, but your clients have no idea what's happening behind the scenes often. And a lot of that can be cleared up in your pitch up front. So BAMX members, 3:00 today. That's our office hours. If you want to get into BAMX, hit the link down below. We'll actually give you a trial to get in. Every Friday we release done for you content. So that can be found right here. Whatever's new this week, done for you, as well as all of our other content and courses. So much in here. So Jump into BAMX if you haven't done so already. Links down below. Get you that trial. And BAMX members, I'll see you guys today at 3. Also, later on the channel, a short interview I did when I was in Colorado Springs with James Dwiggins. And he has it'll be up on this channel, on YouTube channel later today. He has a solve for NAR that I have never heard in my life. And it is exceptional. And it is earth shattering for those in Chicago and NAR. But it is an out of the box solution. And I'm looking forward to saving that or sharing that with you guys. So hit the subscribe button, hit the notification bell. You do not want to miss that electric conversation. It'll be up later today. I'll see the members. I'll see you guys at 3 o'clock. Until then, of course, toodaloo.